Hi everyone, and welcome to the Womenomics Fast 5. The Fast 5 video series is where we spend 5 minutes summarising or discussing a key topic related to personal finance investing and, well, anything else of interest. And this video is going to be all about Vanguard Diversified investments. So let's dive in. So who is Vanguard? The Vanguard Group was founded in 1975 by Jack Bogle, and it's a US-based investment asset manager with approximately $7.7 trillion in global assets under management as of April earlier this year. Now, whilst they are US-based, they have Australian operations and offer many diversified investment options to Australian investments. One of the more interesting points as to how Vanguard came to be is that Jack Bogle, the founder, when he was at Princeton University doing his undergraduate thesis, he conducted a study in which he found that mutual funds did not outperform, and mutual funds, I should add, are active management type investments. They did not outperform the base benchmark, if you will, for example, like the top 200 ASX companies, over time because their fees ultimately eroded the majority of their investment returns. So what that's really telling us is that for the majority of investors, it is far better from a performance perspective and an overall cost perspective to be investing in the types of investments which are created by companies like Vanguard. What is a Vanguard Diversified investment, which is what the topic of this video is all about? Well, in summary, Vanguard Diversified investments, or otherwise referred to as Vanguard Diversified Index Exchange Traded Funds, or for short, ETFs, which is an acronym you will see come up time and time again when you start to research and look into different investment options. These are a low-cost way to obtain broad diversification to multiple asset classes in one single investment. They do also come in the form of managed funds, but we are going to be focusing on the types that are listed and publicly traded on our Australian stock exchange. The beauty, if you will, of these diversified investments is that rather than going out there and buying some shares in Woolworths and some shares in BHP and some shares in Commonwealth Bank and ending up with a portfolio that has quite a large number of investments, which is important when it comes down to diversification, and generally speaking, people advocate for holding anywhere from 13 to 30 different shares or exposures to different investments to be justifiably diversified. The research on all of that does debate the number, but the point I guess I'm really trying to make is that rather than holding an unwieldy number of investments, which you specifically have to look at and review on an ongoing basis to make sure they all make sense in the context of your portfolio, buying a bit of a DIY or do-it-yourself one-stop shop investment, which is not just diversified across, say, Australian shares, but is also inclusive of diversification across global shares, corporate bonds, all sorts of other asset classes, is really, really important, and it's done so well with these Vanguard Diversified investments. I guess put differently, another way you could think of an index fund is it's really just a basket of stocks with hundreds and thousands of different investments all included in one investment. And they generally are very low on the fee basis, which makes the overall process of getting instantaneous diversification very simple and straightforward for investors that are just starting out, or even if you're not just starting out, you're just looking for something that is very straightforward. So that's all fair and well. But of course, where do you begin? What ones do you choose? If you were to jump on Google or even go directly to Vanguard's websites or go to any other providers for that matter, including BlackRock, Russell Investments and so forth, you are going to find there are quite a number of different investment options out there. But in this video, we are just going to focus on the product suite, if you will, of 4 different investment options that are currently available with Vanguard. Even though they have a lot, it's just these specific 4 which they refer to as their diversified investment offering. Now, these 4 are, as you would expect, there's a conservative option, which has 30% of its portfolio in growth assets and 70% in defensive assets, which are like cash and fixed income, very low risk, but also arguably generally lower return investments. We've got a balanced investment option, which does the 50% growth and 50% defensive split. There is a growth option, which is 70% in growth assets and 30% in defensive assets. And there's also a high growth option, which is 90% in growth assets and 10% in defensive assets. Now, these investment vehicles are really dependent on what your risk profile and tolerance is. We're not here to tell you which one you should invest in, nor are we going to be providing any advice at all. We are very much about general information, and if you are unsure about what one would suit you, just really have a good long hard think about whether or not you would be willing to risk a larger proportion of your investment to volatility, which means you could find that it drops 15% in a given year or more or less, or whether you prefer a more defensive approach. There are plenty of tools to play around with on Vanguard's website, which can give you a bit of an indication as to what you could anticipate over, say, 5, 7, 10, 15-year period. We'll leave that in your capable hands, but really what we wanted to do is to introduce you to these 4 key options, just to really strip out all the noise when you're looking at what is available out there in the market to consider. So what I would suggest is going on the Vanguard website, having a look at these 4 different investments. We've included the different ASX codes for you to review and just see what you think. And this is generally where, if anyone's starting out their investment journey for the first time, it's a good place to begin. We would strongly suggest, if you're going to do this, to do dividend reinvesting, but that is something we will cover in another video. So thank you so much for your time today. We hope you found this useful. This video is a little bit over 5 minutes, but the premise is still the same. And if there's anything, as always, that you would like to see us cover in future videos, please feel free to drop us an email or connect with us on any of our social media platforms. We would absolutely love to hear from you. Thank you.